Welcome, everyone. Thank you for joining us for this panel, where we will be discussing the SEC's recent exchange rule 15c2-11 and enhanced retail investor protections in over-the-counter securities. I'm Mahlet Makonnen with Williams & Jensen, and I'll be moderating this panel along with two great subject matter experts that will help guide us through the rule as market participants are starting to prepare for compliance. Before we dive in, I will provide an introduction of our panelists, starting with Dan Zinn, who is the General Counsel of OTC Markets Group. Dan leads the company's regulatory and policy-making efforts and is often a speaker on over-the-counter equity markets. Prior to joining OTC Markets Group in 2010, he served as outside counsel to OTC Markets as partner at the Nelson Law Firm PLLC. Prior to that role, Dan worked in the corporate office of AIG. Dan earned his Juris Doctor degree at the Benjamin Cardoso School of Law and received his Bachelor of Science from Pennsylvania State University. We also have the pleasure of having Stefan Spath on our panel. Stefan has 2 decades of experience in the financial markets, serving in various capacities from equity research and portfolio management to securities trading and investment banking. He is managing director at MCAP LLC, a financial technology developer, an electronic market maker, and global securities markets operator. He began his career as an investment analyst in the corporate finance department at RMC Group PLC. Based in Paris, Stefan managed the currency hedge aspects of RMC's European projects in the years prior to the implementation of the European Union common currency. He earned a master's degree in international business and finance from Thunderbird School of Global Management and a bachelor's degree in economics from Rollins College. Stefan is a FINRA registered principal, having passed the series 7, 63, 55, 65, and 24. Thank you both for joining us today. Dan, let me start with you to give us an overview of Rule 15c2-11. It has been a couple of months, well, years it feels like, since we last spoke about this rule, and the SEC has since published the rule. I'm looking forward to round 2 of our discussion today, and I'm sure you have memorized the rule by now. So I will leave it to you to tell us about the scope of the final rule, what was the SEC's intent behind the rule, and did that intent translate into the final rule? So I'll go ahead and hand this to you, Dan.
Well, thank you, Mahlet, and thanks to STANY and to Stefan for joining as well. And yes, I will now give a recitation of all 297 pages of the rule as per Mahlet. No, I will do my best to give a relatively brief overview of 15c2-11 because I think it'll set the stage for what this discussion will be when we get into the amended rule and some of the practical impact that the rule is going to have on the industry. 15c2-11 has been around for a long time. It's more than 40 years old. And the premise of the rule remains roughly the same. The idea at the beginning was that before a broker-dealer could publish a quote in a system like ours, what's known as an interdealer quotation system, they had to have certain information available about the company. So think about general company disclosure. Under the original rule, and the rule that's still in effect for the moment, once that initial hurdle has been cleared and a broker begins quoting a security, as long as that security is quoted continuously without a break of 4 days or more, it can be quoted in perpetuity. And so that's what gives rise and has given rise to things like no information companies that we mark with a stop sign, or other companies that aren't making a full set of disclosure available. Those companies are available to be quoted under the current formulation of the rule. And so what the SEC did in these most recent amendments is really seek to provide for continuous disclosure. So the biggest change, and there are a few, and we'll dive into many of them, the biggest change is that now, or once the rule goes into effect, for a company to be the subject of continuous public quotes, I'll describe what I mean by public in a minute, there has to be continuous disclosure publicly available. So a public quote in this context is a broker-dealer subscriber, let's say of our system, of OTC Link ATS, that publicly indicates that they have an interest in buying or selling ABCD security. It comes with a price and a size as well. And that quote is made available not only to the other broker-dealers on the system, but also to the general public. when this rule goes into effect, what a public quote means will be slightly different than what a broker might be able to access in other contexts. And a lot of that is going to depend on some of the exemptions and exceptions that we'll talk about as we go. The other big change from where we sit with the amended rule is the ability for the interdealer quotation system, the qualified interdealer quotation system in our case, to make the determination that a company actually has the appropriate amount of information to be the subject either of an initial quote or to be the subject of ongoing quotes. In the past and up to this point, it's been the responsibility of the broker to have that initial information requirement. And now we are going to be able to do that review, make a publicly available determination of whether a company has qualified under that portion of the rule, and brokers and other industry members will be able to rely on that determination. Again, there are some intricacies to how that's going to work with respect to FINRA that I think we'll get into in a few moments. But if you think about the way that will impact the market, it almost provides for something akin to a direct listing, where a company just makes information available. There's a central entity, in this case it'll be us or somebody who looks a lot like us, who may pop up in the market, who will do a review of that information, and then the security will be available for public quoting. And so it will really be a game changer in a number of different respects. I really probably could go on for the duration of this panel and talk more about the rule, but I think that sets an appropriate kind of baseline for where we'll go from here. And so I'll stop there and we'll get into the fun stuff going forward.
Thank you. That's definitely a great high-level overview of what the rule entails. And Stefan, as Dan described, there are a number of exceptions and changes to the rule, and including, what a public quotation means has changed, obviously. So can you tell us a little bit about, market participants and how they view this rule, traders in particular, including, any remaining concerns following the rule's finalization?
Sure. Well, as Dan had mentioned, one of the primary aspects of the rule change is it's shifting the burden from market participants like market makers to the actual marketplace, OTC markets. So in theory, at least, this is going to really kind of relieve a lot of the ongoing compliance concerns that we've had to address as a market participant, primarily as a market maker. MCAP, we make markets in over 3,000 non-U.S. securities, so we're dealing with unlisted ADRs and foreign ordinary shares that trade over the counter. In order for us to actively engage and trade with certain non-U.S. companies, with our institutional customers, we have to satisfy a separate SEC rule, 12G32B, and we have to demonstrate that the company is current with their information and in good standing in the local market with their local regulators. And this creates and has created for market makers like us a compliance burden that is an ongoing burden. And so as it appears now, this burden will be shifted, at least partially, to the OTC Markets Group. And so that is a welcome development for us in many ways. It relieves a certain function that we have to go through to initiate a quotation in a security. We still probably duly maintain our records to reflect the fact that we understand the companies that we would like to quote do in fact qualify for this exemption. But having OTC participating in this and really being a central repository for all information, we think will be very helpful. That's one of the primary aspects of the rule change, which will impact us the most, and it'll impact us in a positive way, I believe.
Dan, how do you welcome that shift in burden that he discussed regarding some of that centralization?
Sure, and that's the perfect question. I was going to build off of what Stefan was saying. We already do so much of that, and really what the SEC's done with the amended rule is recognize a lot of the work that we do now. So for those who aren't familiar, there are roughly 11,000 or so securities quoted on our market, and we organize them into different marketplaces and tiers based largely on the timeliness and sufficiency of the disclosure that they provide. So at the top level, where you have things like our OTCQX market or our OTCQB market, which is the middle market, or even the pink current market, we are already going through a review process, looking at company disclosure and qualifying a company to be placed into one of those tiers. So we have the infrastructure already in place. And so we welcome, it's a very long way of saying we welcome the shift in responsibility. It's something that we're prepared for and that we believe we do now. And it's encouraging in many respects to see that the SEC shares that belief. And to the extent it helps people in Stefan's position, and his firm and many others, it will allow them to, instead of focusing on that initial compliance responsibility, really provide a more efficient service for their customers. And in that way, the rule really has the underpinnings of an efficient market operation. And so that's the hopeful spin on all of this. But I really believe that because of the way it sets up, the market's going to see a lot of those kinds of ancillary benefits as we take on officially some of the burdens that we've been shouldering already in many respects.
Well, not to be a pessimist here in the group, but we talked about some of the benefits of the rule, but there are obviously some downsides to it as well, depending on who you're talking to. So let's talk a little bit about the remaining action items that are left for market participants in the space, and including what will happen to the companies leaving the market. And I'll kick it to both of you on this.
Sure. Go ahead, Stefan.
Well, for us, given the unique position of MCAP, we're dealing with, as I said, non-U.S. issuers. And so we're not dealing with any of the non-current domestic securities that may be affected in a negative way from their perspective. If they're not current with their information, the new rules on how the gatekeeper must police the market is going to change their lives. Either they must become current with their publicly available information, or they're going to be put into a different tier. And that could have an impact on their shareholders, perhaps. But again, that's not my area of expertise, nor is it the area that we typically deal with. So Dan can probably expand on that and discuss what they're attempting to do as far as an expert market, which is going to be a new tier to address the issue of companies that are no longer qualified to be on the pink tier or on the premier tier, which is OTCQX or OTCQB.
It's an outstanding segue. Thank you for that. And to address that, and really Mahlet's question, there are a number of open items and things that we're working on. I think it might be important to set the expectation for what the timing of all of this is. The final rule was published in September, or came out in September of this year, was published in the Federal Register last month. And so the end compliance date when all of these changes will really take effect is September 26th of 2021. And so between now and then, there is a lot to get done. And Stefan referenced the expert market, which is really chief among the things that we continue to work on with the SEC. And this goes to what I was talking about earlier with respect to what a public quote is versus what a broker-dealer may be able to access over time. So for companies that don't qualify for public quoting, and the easiest example are those no information companies, instead of disappearing from electronic markets altogether and moving to what we call the gray market, where it's brokers calling one another and you don't have the opportunity for price discovery or to show best execution in the same way that you do in a traditional modern electronic market. What we're working on with the SEC is this concept of an expert market, which would allow brokers to continue to access a system like ours, to continue to quote and message one another, have that level of price discovery, and to provide that information only to a set of sophisticated investors. So really the difference between the publicly quoted market and the expert market is who has access to see that real-time quoting activity. And if you remember earlier, I was talking about what the SEC's underlying goal in these changes really is all about. And they seek to protect the retail investor from seeing a really active market in a no information security, with the concept being if they see an active market and they see real-time quotes, they're going to be more susceptible to fraud. So the expert market will be limited in quote distribution to institutions, to broker-dealers, all the way down to folks that would qualify as accredited investors, but would not, importantly, be made available to the general public. And just to be clear about where this stands, we had commented several times about the expert market, and many commented in favor. which was very nice to see. The SEC addressed it in the adopting release for the rule, while not adopting it in full scope at that time, but indicated that they would be open to a separate exemption for the expert market. And we continue to work very closely with them and obviously appreciate their efforts there, and believe that an announcement on the expert market or seeing that exemption come to fruition is fairly close at hand. There are other exemptions as well that I think we can get into as we go, but that's probably the biggest thing because, Mahlet, going to your question about what the potential negative impacts are, clearly the first thing you're going to think about is seeing all of those no information companies, and there's roughly 3,500 of them, no longer be quoted. If you're a holder of those securities or a sophisticated investor who invests in that type of company, you're going to want to make sure there's really an active market and a place for your broker to get the best price for you. And so we believe that's going to be the outcome, and we'll obviously keep everybody updated as we learn more from the SEC.
Right, and I'm sure a lot of people welcome the expert market exemption, and as that moves forward, I'm sure that will be a welcome change. Let me follow up a little bit on that, on where the SEC, and not just the SEC, who's a player in this space, and FINRA are headed moving forward on this. You mentioned there are a lot of other exceptions to the rule, but there is also some uncertainty with that as well. So can you touch a little bit about some of those exceptions and where there's a gap there that there needs to be some clarity, both from the SEC and FINRA?
Sure, and maybe I'll jump in, and then I kind of want to pose a question or two to Stefan from his perspective about some of these things as we go. So in terms of remaining exemptions, and again, this was touched on a little bit in the adopting release, so I don't think it's news to anybody, but the SEC built in an exemption from the initial information requirement for certain non-US issuers that meet metrics, meet certain thresholds that were set out in the rule. We are also working with them on additional exemptions for continued quoting of some of those securities. So whether that's securities that are in a certain index or that otherwise meet a specific threshold, instead of having an obligation, and Stefan touched on this earlier, to do a continuous review of information, as long as they continue to meet certain metrics, from the SEC standpoint, they're really taken out of that group that makes retail investors more susceptible to fraud. A press release or two on a major international company is not going to move the needle and is not going to be the basis for a fraudulent scheme. And so the SEC recognizes that, and in the same spirit of continuity that really gives rise to the expert market, wanting to see holders of those securities have a continuous market, they're open to and have been working with us on exemptions for international issuers that meet different thresholds. There's also discussion of exemptions for additional types of securities. If you think about banks as a potential example, that's one direction that we think the SEC can go in. So that's one of the things I was hoping to get Stefan's take on, particularly with respect to international companies. The other is what you addressed, Mahlet, with respect to FINRA and FINRA's involvement. So the rule that's changing here is 15c2-11. It's an Exchange Act rule governed by the SEC. FINRA has a companion rule, 6432, that has for a long time required brokers to file a specific form with FINRA when they want to initiate quotes. Now, as we've talked about, instead of that responsibility being on the broker going forward, that responsibility really lies with us or somebody that looks a lot like us. And so one of the open questions that we are planning to speak with FINRA about, and they're have been willing to engage, which is nice, is whether that obligation is going to persist on brokers. Is there really a need for a broker to file a form that says, we've checked with OTC markets and they've made a publicly available determination that this security qualifies? But until we have some clarity from FINRA about exactly how that will work, I think it's an open question as to what the workflow will actually be. So I'll leave all of those open items out there for Stefan to address, but I think that's kind of the next set of questions that we have.
Well, for us, we're looking at this as it's work as usual until we get further instruction from FINRA. At this point in time, you had mentioned September of 2021. Perhaps we're going to have to wait to that point until anything is finalized. But for us, we're entering new issuers into the marketplace on a monthly basis. So at this point, it still requires us to go through the motions and file a Form 211 to comply with the SEC rule 6432. And that is not going to change until we're notified by the regulators. But again, that is a process where, as Dan is well aware, a market maker cannot be compensated for filing a 211. So we have to demonstrate that we are performing either a bona fide service, or we simply have no contact with the issuer, but would simply like to create a U.S. symbol to give more transparency to the symbol in the U.S. market for trading with our U.S. counterparties. We also have to deal with another SEC rule called 5250, which in the event we are engaged with an issuer on an advisory capacity, and we may in fact receive fees, we have to demonstrate those fees are for bona fide services and not for market making. It's a really obscure rule, but again, this is one of the reasons why we believe as this new rule is implemented, we're going to see an efficiency take place where the OTC markets is going to be the primary gatekeeper. And then, of course, there's going to be a continued responsibility on the part of market makers to maintain our own records to demonstrate that we believe this company is current with all of their information, and that's what allows us to be comfortable in quoting the security. But it's going to be a very complementary type role with the primary responsibility on OTC. And again, as I mentioned earlier, we do welcome that because we do think this will make the marketplace more efficient, more transparent. And we welcome it, and we're willing to participate as a market participant at the table in the event FINRA would like to get feedback from the other side of the table, which are the companies that are putting up risk capital to quote and make markets and securities. And so OTC markets and MCAP and other market makers in this space are all really in the same sandbox. And we would like to implement this rule in a way that makes the most sense for the most players. And that's where we stand. And I think that's where we're going in the future.
I know you can't see me when Stefan's talking, but I'm just sitting here nodding my head and agreeing with a lot of those points.
We can feel it.
Right, exactly. Hopefully the positive energy flows.
You know, you both talked about compliance, and obviously on both ends, it's happening right now. I was going to say what next step, but actually this is an ongoing process. It's already begun. So as time is ticking for compliance with this rule, if you can dive in a little bit more on what firms and participants should consider. Obviously, there are costs and other considerations in any compliance, if it's good or bad, there are costs to consider. So I'll leave it to you both to give a little bit more depth to what compliance will look like in the next 9 months.
Sure, and this builds on a lot of what Stefan was just talking about, where we're taking on a degree of responsibility here that had previously rested with the broker-dealers. And that's, I think, the right way to build a compliance process because we already have this infrastructure and because we already do these types of company reviews. And Stefan mentioned, it's business as usual for them, and I think for all of our broker-dealer subscribers, until told otherwise by a regulator. But in terms of costs and builds and what has to happen from here on out, we want to make sure that everyone has the workflow set forth in front of them as quickly as possible. So, for example, using that FINRA Rule 6432, if brokers are still going to have to make a Form 211 filing, they need to understand that, and then we need to understand and work with our brokers to make sure the workflow of actually getting a quote onto our market is well understood. If it's going to be something other than that, if a broker is just going to be able to rely on our determination, then we want to make sure they understand exactly where to find that determination on our market, how to build that into their own records and their own processes, and ultimately how to publish a quote more efficiently on our market. So things like that are going to be really important. Our hope really is that a lot of the costs and the behind-the-scenes work are things that we are going to bear. That's really the role we believe we play in this market. And so the processes and procedures for reviewing company information and for ensuring compliance with this new amended rule are going to fall on us. And that's partially why we requested and are happy with the time frame that the SEC gave in adopting the rule. But as we develop our procedures to the extent they impact our market makers down the road and our broker-dealer subscribers. We want to give them as much time as possible to build any systems or any back-end compliance processes that they need to, so that on September 26th, it's not a surprise and we've all tested, and once the switch gets flipped, the market continues to operate very smoothly.
Well, do you, we're coming up on the end, and I wanted to say if there are any follow-up rules or guidance that you foresee the SEC, and obviously FINRA, there's some clarity that the agency has to put forward according to a lot of people. So is there anything that you see in terms of rulemaking on this, additional rulemaking on any piece of this, or do you think this is as final as it is now?
I'll defer to Dan as the attorney, his area of expertise.
I think with respect to the rule itself, I think the SEC only has and this is not a knock on them at all, but it only has the appetite for amending a rule like this once every 30 or 40 years anyway. But I do expect to see interpretations, and clearly the exemptions that we're talking about, whether that's the expert market or international, or things like bank or potentially even other issuers, that's going to be publicly available regulatory information that's out there. There are a few other open questions for the SEC around how they're treating shell companies and certain kind of around the edges compliance areas or questions that I believe they will issue guidance on. And again, that's part of this long-term process we have to reach that compliance date. And so in working with the SEC, my understanding really is that they have every intent of making this as understandable as they possibly can, which is a wonderful stance for a regulator to take. And so if the SEC is able to put out that kind of interpretive information, and FINRA is able to do the same with respect to the obligations of broker-dealers under the FINRA rules, there is, again, I'm taking the hopeful stance here, but there is a really good possibility that this becomes not only a more efficient market, but also a more well-understood market for investors, for brokers, for companies that are interacting here.
Well, I certainly have taken an optimistic viewpoint after this discussion anyway. So, Stefan, Dan, of course, always a pleasure. Thank you so much for coming on the panel. It's certainly useful for those as they start the compliance process, which can be daunting, as those of us that have been in the regulatory world know. So to those of you that have tuned in, thank you for tuning in, and thank you for joining us. I hope you all have a great day.